Private Equity Talk, der Podcast des Private Equity Magazins.
Warm welcome. I'm here with Nicola Palmer of QIC. She's a partner at QIC, stands for Queensland Investor Corporation. You're now in Europe. Normally you're in Australia. What brings you to Europe?
Yeah, look, thank you very much, Tarek. I've come here for the Berlin Infrastructure Conference. And as you probably know, there's normally officially about 2,000 infrastructure investors that turn up for a few days in Berlin. And then there are at least another couple of thousand people who generally habitate around the conference. So it is the most amazing opportunity to catch up with both infrastructure managers and pension funds and insurance companies investing in the space from all over the world, not just Europe. We QIC have had a big team over from Australia, from London and from New York.
Yeah, and it seems to be really the most relevant conference in the infrastructure world. And people try to travel from all places in the world to see their counterparties and investors and GPs alike. Maybe you can say a few things. What is QIC? What are you doing in the infrastructure world?
Absolutely. Yeah, absolutely. So QIC is a funds manager based originally out of Queensland, but we've now got 5 offices around the world, Brisbane, Sydney, Melbourne, but also London and New York. QIC originally managed money on behalf of the Queensland Government Pension Fund, but over the course of the last 10 years has expanded that into also managing money on behalf of third-party capital, and now has Australian dollar 29 billion of assets under management in the infrastructure sector and 100 billion more widely across other asset classes. But in the global infrastructure team, we've been very successful in investing on behalf of both the Queensland Government Pension Fund, but also third parties. Our investment focus is primarily on Australia. So historically, about 70% of the assets have been in Australia. Going forward, 50% of our allocation is towards Australia. The balance is between North America and Europe. So we do have a global focus, but on those 3 markets. The 3 areas that we typically invest in are the transport space, the energy sector, and in social and healthcare. I myself am the head of origination on the transport side. So I focus primarily on Australian origination of transport, but I also work very, very closely with my European colleagues and my US colleagues looking at transactions in those markets. I joined QIC about 12 months ago. Prior to that, I spent 16 years in the European market, and prior to that in Australia. So I have very good, deep knowledge of the European market and of the Australian market, and obviously leveraging off my US colleagues in the US as well.
That's very amazing. And you do focus on infrastructure equity personally, but QIC also would cover not only infrastructure equity investments, but my understanding is also some investments in infrastructure debt.
That is correct, yeah. But the global infrastructure team that I'm with are primarily focused on equity investment, but we do have a QIC debt team, and they were also in Berlin. So you're getting equity investors, but also debt investors there too.
Perfect. So what was your take from the conference? Anything that you felt was standing out, or maybe just being back after the pandemic? I guess it's one of your first conferences that you attended. Any thoughts from now that the conference is just over?
Yeah, absolutely. I mean, you're absolutely right. I think there was a real buzz. Many people had not attended the conference since before the pandemic. There was a conference last year, but it was much smaller, and apparently it was a COVID super spreading event. So lots of people got ill afterwards. We're hoping that won't be the case this year. But everybody was super keen to be back. There were lots of people I hadn't seen for a while. I think generally people felt very positive about infrastructure investment. Although there is absolutely no doubt that over the course of the last 6 months, with the economic turmoil in the listed markets and then the more recent events in the US and in Switzerland with the banks, that investors are pulling back in terms of their allocations to infrastructure in the short term. The pension funds are all suffering from the denominator effect, which means that because alternative assets have been so successful, they are relatively overweight in that asset class relative to the listed market. So they need to sort of pause their infrastructure allocations and sit back and let everything sort of come back into balance. So I think looking forward at the back end of the year, people are anticipating getting going again. But certainly right now, many people are saying that they're not in a position to invest currently.
Obviously, it's a bit challenging time, and people are watching the banking space. But overall, you said there was a bit of a buzz at the conference, and people were at least considering sort of things. Any interesting trends or topics that you saw was that there were kind of the overall themes of the conference that you saw?
Yeah, absolutely. So, we've experienced 10 years of very strong returns in the infrastructure market, and that has been driven by continued low interest rates. So that has driven asset values, but also infrastructure assets have been the beneficiary of cheap debt. So I think everybody's very conscious of what's going to happen as interest rates rise. A lot of infrastructure assets are well hedged, so there shouldn't be any issues or liquidity issues in the near terms in terms of their assets. But it will mean that some assets will need to look at flowing through increases in prices as those higher interest rates and inflation kick through. And so it'll be a question of whether or not they can all achieve that and do that. Equally, it's going to have an impact on equity rates of return, particularly at the core end. So we've seen over the last 10 years the asset prices for core assets going higher and higher, and the rates of return, going into the sort of 6 to 8% IRR level. There is no doubt that as the returns on debt are reaching those sorts of levels, that core infrastructure assets are going to reprice. I'm certainly already observing that in some of the selective processes that we're involved in. But I think that's going to be a continuing trend for this year. And the combination of that, together with some of the pension funds pulling back from the market, will mean that for the first time in probably 5 years, there may be some quite interesting buying in the core space for fund managers who for the last 5 years have really struggled to invest at the return levels that they're looking for, the double-digit return levels that they're looking for in the core space. So I think we'll be able to revisit this part of the market. Interesting.
Interesting. Yeah, I mean, I think when I look back at the global financial crisis back in 2008, 9, 10, there were a lot of investment opportunities that turned out to be great investments. So sometimes times of economic change or a little bit economic turmoil, I think, while it's understandable some players will sit on the sideline and don't do anything, ones who are a little bit courageous and do investments, they have, I think, in the past been blessed with good investments. And you have to be maybe take a bit more uncertainty in the calculations. Maybe it's a less clear path forward.
Yeah.
I think infrastructure, maybe you can say a few things about it because you mentioned inflation. Infrastructure seems to be also like real estate because it's covering real assets, a bit of a hedge against the pressure from inflation and pricing.
Absolutely. Yeah. Look, as a general statement, infrastructure does offer really good inflation protection, but it is not the same for every asset. So you do need to look very, very carefully at each individual infrastructure investment to see, does it really have that inflation protection? So you may have a regulated asset where inflation is directly passed through, or you may have an asset that has a contractual arrangement long-term, which allows full inflation pass-through. Those definitely have that protection. Then there are others where it's less explicit. And so you've actually got to pass those pricing increases through to your customers. There can be a lag. So it may be that you only have the ability to renegotiate that contract pricing annually. So you end up with a lag. And when inflation is so strong so quickly, that lag can impact the returns of your investment. And then the other issue is whether or not your customers actually can afford to be hit with that inflation pass-through. And it will be a test, I think, for the infrastructure assets as to whether they can actually achieve that.
Mm-hmm. Do you see differences in the, let's say, sectors? You mentioned that QIC is involved a lot in transport and as well as in energy. Do you see that those sectors are kind of diverging in terms of inflation or?
Yeah, so if you look at the energy markets, the pricing of a lot of energy assets is driven by a lot more by supply and demand than it is necessarily by inflation. So you've had great increases in energy prices in recent times. And so some of those assets, particularly if they're on the receiving end of revenue from merchant risk, have done incredibly well. But I wouldn't say that they necessarily offer inflation protection as such. By contrast, the transport sector does have prices where you can pass through to your customers increases in your underlying costs like labour, etc., and increases in revenue linked to inflation. But that is only the case if there is really strong underlying demand for the assets. So I think that the risk for transport assets will be if there is some sort of economic downturn that impacts volumes, then that may mean that they won't be able to pass through those price increases. At the moment, you've seen supply chain crisis across the world for the last couple of years. Huge demand for transport assets, huge need for intermodal assets, for ports, etc. So that hasn't been a problem. Whether it becomes a problem if there is a wider economic downturn will be interesting.
Yeah, you could see, I think, after the pandemic that many sectors bounced back, like the flight industry and the airports. People are traveling again, both for business and pleasure, and I guess there's a change. At the same time, the governments in different jurisdictions try to renew crucial infrastructure, or they are also moving due to sustainability issues, maybe moving away in the energy sector from less sustainable industries to more sustainable industries. So I guess there's a lot of influence from the government. Maybe you can have some thoughts on that. For instance, also the US had this Inflation Reduction Act. Is this affecting your investments in some way?
Absolutely. Yeah. So, I mean, we, like many infrastructure investors, have been very focused on investing into the energy sector over the last 10 years and looking at investments into renewable energy, into storage, district heating investments, all of those sorts of areas. Where there is a shift now is the focus of decarbonisation around the transport space. So, the Inflation Reduction Act has measures in it that is going to continue to support the deployment of renewable energy in the energy sector. But there's also an awful lot in there that is going to encourage decarbonisation of transport, including provisions to provide direct subsidies for production of things like green hydrogen, subsidies for the deployment of EV charging, subsidies associated with EV vehicles coming into the US market. So for us as an investor, we are really focused on how can we invest into that decarbonisation of the transport space. It's having an impact on our existing assets. So we have a number of port investments, both in Australia and overseas. We have airport investments. We have investments into toll roads. And we're looking at how can we position those assets to make sure that they can decarbonise, whether it's looking at transport of goods into the ports or our customers arriving, the ships arriving at our ports, and making sure we're putting in place bunkering for alternative fuels. In the aircraft industry, we're looking at initiatives around SAF, whether we might ourselves invest in SAF facilities so that we have the ability to supply that fuel to our airports. So in the first instance, it's impacting our existing assets. In the second, we're looking at new opportunities, new types of infrastructure that are coming into the transport space that we can also invest in. So we're currently looking at investing into an EV charging network. We're looking at some hydrogen opportunities. And, these are relatively high risk, high return opportunities today. So we're, from a portfolio construction perspective, looking at slightly smaller levels of investment into those areas. But what we hope is that these will become, core infrastructure of the future.
Has this Inflation Reduction Act made the US as an investment destination more attractive vis-a-vis, let's say, Europe? Or is it really depending on the different initiatives? Because Europe has also initiated the European Green Deal. It's a different focus a little bit, but there's some similarities and.
Yeah, look, I think Europe has always been an attractive market and will remain an attractive market because of all of the regulatory support that's provided by the European Union and all the different governments. Equally, the US market has been a very interesting market for investment into generation assets. So despite the fact that there haven't been the subsidies at the federal level, they have been provided at the state level. And the US has got good sort of renewable resources that make it attractive. I think where the difference is with the IRA is it is providing the boost into some of these other aspects that will be required to decarbonise the US market, particularly, as I said, around transportation. So we haven't seen subsidies for EV vehicles in the way you have for Europe previously. Certainly the subsidies around production of green hydrogen are really going to provide a boost to that sector. I think on the transport side, it's going to make the US market a lot more interesting.
I guess cheap energy prices, or relatively compared to Europe, energy prices in the US also helps, I guess, to make it an attractive market at the moment.
Yeah, absolutely. And look, one of the other things I would say is that what was really interesting in Berlin is how interested investors were in the Australian market as well. If I'd had a conversation with a European investor 5 years ago about investing into Australia, they would be probably quite uninterested. There was so much opportunity in Europe. They felt that they could get a level of diversification by just investing into different European countries. Now with the Ukrainian war and the impact on energy prices in Europe and the supply of energy into Europe, it's impacted almost every aspect of their infrastructure portfolios. And they realize that by being invested in Europe, they're not actually as diversified as they thought they were. And so they are looking to economies like the US, where you've got access to relatively cheaper energy, but also Australia. Australia is currently the 4th largest energy exporter in the world. It has really good access to raw materials like nickel and cobalt and lithium and iron ore, all of which will be required to sustain the energy transition. They have amazing quantities of land and sunshine, which will be really important to the deployment of solar at very cheap prices. The government is already setting up and identifying hydrogen hubs where they are looking to use renewable energy from solar and wind to produce green hydrogen, which they're hoping to export to markets like Europe, Japan, and Korea. So if you're a European investor trying to diversify your portfolio, having exposure to markets like Australia and the US really expands that diversification.
And I guess you also get directly or indirectly, some kind of access to the Asia Pacific market due to Australia's closeness to, as you said, Japan and other important Asian nations.
Absolutely.
I guess that's also a factor.
Yeah, absolutely. You're getting the export markets are primarily into Asia. Japan, Korea, China is still a very important trading partner. But I think we're also seeing increased interest from Europe in trading with Australia because it's also trying to diversify its source of agricultural products, energy, away from some of the other markets that they have had these things from before.
And so we spoke about, QIC, the conference, and the energy sectors. What about investors? You mentioned already that there was some kind of special interest from European investors that look for some diversification. Any other trends that you see on the investor side, different players or different things they look for?
An increasing theme. So lots of investors are interested in how they can get direct access to infrastructure assets. And so the vast majority of investors that we've spoken to are interested now in investing not just in funds, but also doing co-investment alongside the managers. I think almost every investor we spoke to was interested in that. QIC has got a great track record of delivering co-investment because of the fact that it managed money on behalf of the Queensland government. That was the core nature of its business was doing that. In our last fund of the 3.5 billion that we raised, we've already delivered about 3 billion of co-invest. So that resonated really, really well. I think the other thing is that European investors are getting an increasing appetite for risk, thinking about not just having core assets in their portfolio, but also value add, slightly higher risk, higher return investments, and even more core plus PE style investment, particularly into areas associated with energy transition. And there's probably two factors driving this. One is just a desire to improve returns. And the issue that we spoke about before with concerns around interest rates makes them relatively less interested in core. But then there's a sustainability angle as well. So, they all want to make sure that they've got a very strong component of ESG-friendly investment in their portfolio and are prepared to take on more risk to invest into things like the deployment of EV charging or hydrogen in order to ensure that they have that within their portfolio.
Mm-hmm. Do you see also a demand for separate managed accounts, or typically people would start off being investor in a commingled fund and maybe then hope for getting some allocations for co-investments?
Yeah, the latter is by far the strongest model that I see. People coming into a commingled fund and then looking to piggyback off the manager to do some co-investment alongside. There are some larger pension funds that have their own in-house teams who are looking at doing direct investment themselves. Some of those will do it via managed accounts, and some of them will just simply do it with their own infrastructure teams and become, I guess, more like a partner for a fund manager like ourselves rather than, necessarily a client.
Fantastic. ESG, sustainability, I think we spoke about already. Any other big trends that you see? I mean, other than maybe also inflation as a thing that people have to deal with, but any other development? Is I mean, what we see now also with artificial intelligence or these kind of technological breakthroughs. Is there something that you see is affecting infrastructure in the short to middle term, or is it maybe a longer play?
Absolutely. Technology has an incredible role to play in infrastructure, and even traditional assets are going to be fundamentally changed by technology and the explosion of data and interconnectivity. So if you think about a traditional port investment, we are looking at being able to track containers as they come towards the port, to actually slow down the transport of those containers to the port so that when they get there, they can be immediately offloaded off the truck to reduce the truck waiting times, and then to be already directed towards the container stack that is going to optimize the movement of that container onto the ship, which is also being tracked coming into the port. And then once that container goes on the ship, it continues to be tracked as it goes to the port on the other side. That sort of connectivity on the intermodal side can have a really profound effect in reducing operating costs, reducing waiting times, being able to track the quality of the goods that are actually inside the container if you've got sensitive goods, and to really improve the efficiency of the intermodal turnaround times. And that's important also for decarbonisation, because if you're trying to get traffic off-road and onto rail and onto sea, one of the biggest barriers to that is the efficiencies around the intermodal interchange. So having the technology to improve that allows you to really get that working. And that's just one example, but every single infrastructure asset is being impacted by this sort of technology. Again, technology itself is something that infrastructure investors can also think about investing into. So when we're talking about opportunities like EV charging, you're not just going to own a distributed network of EV charging stations. You're going to be looking at what is the IT support that sits behind that. How are those stations actively managing their consumption of energy across the grid? What monitoring are you doing of your utilization and your usage, or your availability? If you're having maintenance issues associated with any of the charging stations. So any of this new infrastructure that we're investing in always has a very strong technology component sitting behind it. And that is only going to accelerate.
Yeah. Nicola, I think that brings us to the end of our little talk. It was a pleasure talking to you.
Yeah.
At the occasion of the Infrastructure Global Summit here in Berlin. And it was a pleasure. Hope to see you next year again. And all the best. And it was good talking to you. And I'm saying goodbye. I'm Tarek Mardini, partner with Folge, and